This is the second video in a series called The Financial Crisis Timeline. In my first video, I talked about Bear Stearns and Countrywide and how the inflationary pressures of the summer of 2008 led to economic slowdown. In this video, I'm going to be talking about September of 2008, which was a historic month, probably the single most important month to date in the credit crisis. So let's start with Freddie Mac and Fannie Mae. On September 5th of 2008, the U.S. government took over both of these government-sponsored enterprises. Freddie Mac and Fannie Mae had both guaranteed a lot of very, very risky subprime mortgages and loans, and they were not getting the inflows of cash necessary to pay off these debt obligations. So this was obviously a very severe problem, and the entities were insolvent. The U.S. government takes them over. Common shareholders are wiped out, and the market certainly got a little bit scared because they realized that subprime mortgages were a much bigger problem than they originally thought. This was compounded by 5 days later, when on September 10th, 2008, Lehman Brothers announced a $4.9 billion third quarter loss. In 3 months, they lost nearly $5 billion. That's nearly $20 billion a year on an annualized basis. And guess what? Most of these losses were once again tied to subprime mortgages and related securities. So this really started freaking the market out, and especially with Lehman Brothers stock, investors started selling and selling and selling, and many people feared a run on the bank, which I'll talk a little bit about later on. To make matters even worse, that weekend, September 12th and 13th, AIG took a $40 billion loan from the U.S. government. AIG stands for American International Group, which is a major insurance company. And once again, this had to do with risky securities, credit default swaps associated with subprime mortgages. So all the arrows were pointing in one severe problem, and that problem was the subprime market. Over on Wall Street, a lot of CEOs were getting increasingly concerned. One of these CEOs was John Thain at Merrill Lynch, and he thought that Merrill Lynch might collapse. So he decided to sell Merrill Lynch and all of its assets and liabilities to Bank of America for $44 billion. So clearly, all of these events created a major crisis of confidence in the market. And the major fear was the concept of a bank run. What happens in a bank run is deposits are withdrawn from banks at a very rapid rate because of instability. Things like Lehman Brothers, things like AIG, people don't have as much confidence in the system, so they pull out their money very, very fast. As a result, the bank's capital base is reduced. They don't have enough money to meet their short-term obligations, and this creates further instability and a lack of confidence in the system, and so on and so forth. More and more deposits are withdrawn from the system, and this can lead to the collapse of an entire banking industry in a matter of weeks. And bank runs have historically played a very important role in history. They're a common theme in the financial crisis. So some examples include the Panic of 1907, the Great Depression, and the savings and loans crisis of the late 1980s. This crisis was no exception. Quickly after Lehman Brothers' collapse and all of the events that I discussed earlier, there were rapid withdrawals from weaker banks, which included Wachovia and Washington Mutual. And both these banks were quickly wiped out. Wachovia was sold to Wells Fargo, and Washington Mutual, the assets were sold to JP Morgan Chase. So, as you can see, the events of September 2008 were very severe. The stock market got driven down rapidly after that. And in my next video, I'm going to talk a little bit about the proposed solution, Hank Paulson's TARP program. Was it effective? What was it really all about? Thank you very much for watching, and for similar videos, I recommend you check out www.canjo.com.